Imagine buying a house in 2025 only to see its value crash by 20% before you've even unpacked. In cities across America, home prices are dropping, listings are piling up, and thousands face the reality of being underwater on their mortgages. So which places are most at risk? From Cape Coral's insurance nightmare to Oakland's 30% plunge, 10 U.S. cities are now flashing red warnings, the worst places to buy a home this year. Which cities made the list, and why are buyers and sellers stuck in a cycle nobody saw coming? Here's how we ranked America's most vulnerable markets. Across the country, the warning signs are everywhere. Home listings have jumped more than 20% compared to last year, flooding the market with choices buyers aren't eager to take. The average home now sits unsold for 30% longer than it did just 12 months ago. Sellers who once expected bidding wars are watching their properties linger, sometimes for months. At the same time, affordability has stretched to a breaking point. Monthly mortgage payments swallow about 35% of the median household's income, well above the 30% threshold that signals financial strain. Down payments have soared past $70,000 for a typical home, pushing many would-be buyers to the sidelines. These numbers tell a clear story. Demand is weakening, supply is swelling, and the cost to own is higher than ever. It's not just a blip. The national market is showing cracks, especially in cities where these stress points collide. That's why these metrics, inventory growth, days on market, and affordability, form the backbone of our ranking. In 2025, they're the early warning sirens for deeper trouble ahead. Each city in the countdown was scored using a 5-factor model designed to separate temporary stumbles from real danger zones. The heaviest weight, 35%, went to year-over-year price declines. Cities with the sharpest drops moved to the top of the list. Inventory spikes and days on market counted for 20%, since a flood of unsold homes usually means buyers are walking away. Affordability, measured by the price-to-income ratio, made up another 20%. If a city demanded more than 7 times local income for a typical home, that was a warning sign. Local economic and migration pressures factored in at 15%, flagging metros where jobs are drying up or people are leaving faster than they're arriving. The final 10% went to hidden costs, things like property taxes, insurance hikes, or climate risk premiums that can quietly push ownership out of reach. To even be considered, a city had to cross the danger line in at least 3 of these categories. That filter kept out places with just a single bad stat and zeroed in on markets facing a true chain reaction of risk. With the selection engine set, the countdown begins. Florida's housing crisis has become a case study in compounding risk. In Cape Coral, home prices have dropped nearly 20% since their 2022 peak. For thousands of owners, the pain goes deeper than falling values. Insurance premiums in Lee County have more than doubled in 3 years, with many policies now topping $7,000 a year. Major insurers like State Farm and Farmers have either pulled out or hiked rates by over 70%. For a family who bought at the height of the boom, that means being underwater by $80,000 or more, while still paying record premiums. Some retirees, once drawn to the Gulf Coast for its affordability, now face policy non-renewals and can't sell without taking a massive loss. West Palm Beach tells a similar story, though the numbers are smaller. Prices are down 8% from the peak, but property listings are up 18% year over year. Hurricanes and insurer exits have pushed monthly insurance costs up by $300 to $500 on average. Many owners, especially older residents on fixed incomes, are now stuck. Some can't find any private coverage at all and must turn to Citizens, the state's insurer of last resort, just to keep their mortgages. Jacksonville hasn't escaped the spiral. Home values have slipped 7.5% in the past year, while inventory has surged. New construction boomed during the pandemic, but demand has dried up. Days on market now average above 55, and sellers are forced to cut prices to attract buyers. In neighborhoods just south of the city, recent buyers report being underwater and unable to refinance. Rising property taxes and insurance have only added to the strain, leaving many owners trapped between falling values and rising costs. Miami's market is cooling as well, with prices down 6% year over year. The real shock comes from the insurance side. After State Farm and AAA exited the market in mid-2024, flood and hurricane premiums soared. Typical policies now cost $8,000 to $10,000 annually for many homes near the water. Some buyers can't even close on purchases because no insurer will write a new policy in high-risk zip codes. Deals fall through at the last minute, and sellers are left holding properties they can't move. Across these 4 metros, the pattern is clear. Climate risks drive up insurance, which pushes more homes onto the market. As supply climbs and buyers vanish, prices tumble. For many Floridians, the dream of homeownership has turned into a slow-motion financial trap, one where even selling isn't a way out. Oakland's housing market is in freefall. In some zip codes, home prices have plunged nearly 30% from their pandemic highs. Agents in East Oakland started sending out emails in late 2024 with subject lines like, "Price slashed by $200,000. Sellers desperate." Open houses that once drew crowds now see just a handful of visitors, or none at all. Investor groups that piled in during the boom are now dumping properties, warning each other in group chats, "Don't catch a falling knife." The exodus isn't just about money. Tech layoffs and remote work have pushed thousands to leave for cheaper cities. Bay Area census data shows Oakland lost over 2% of its population in 2 years, one of the sharpest declines in the country. For local families who bought at the top, the result is negative equity and a harsh choice: sell at a huge loss or stay put and hope for a turnaround that may never come. San Francisco is facing its own reckoning. Since 2021, home values are down 11% across the city. The rental churn is even higher. More than 30% of renters have moved out since the pandemic began. Remote work, high taxes, and rising crime have all played a part. Reddit threads and local forums are filled with stories of tech workers leaving for Nevada or Texas. One former renter described giving up her $3,000 San Francisco apartment to work remotely from Reno, trading city life for a backyard and lower costs. For sellers, the market is unforgiving. Listings linger for months, and deep price cuts are now the only way to attract buyers. In Los Angeles, the numbers are less dramatic, but still alarming. Median home prices are down 7% from their 2022 peak. The city's sky-high base prices mean even a modest drop translates to six-figure losses for many owners. Large investors and funds like Blackstone have pulled back sharply, leaving a glut of unsold homes, especially in the San Fernando Valley. Sellers keep cutting prices, sometimes by $100,000 or more, with little movement. The affordability squeeze is real. Monthly payments on a median home now top $5,200, a level out of reach for most local households. Denver rounds out the western slide. Home values are down 5% year over year, but the real story is in the outer suburbs. iBuyer companies like Opendoor and OfferPad, which snapped up homes during the boom, started dumping their inventory in late 2024. Internal calls leaked to local blogs revealed one goal: cut losses before summer. In neighborhoods with heavy iBuyer presence, price declines are steeper and listings stack up. Some sellers, seeing no offers for months, are forced to take steep discounts just to get out. For buyers who thought Denver was a safe bet, the reversal has been swift and painful. Across the West, the pattern is clear. High prices, tech job cuts, and investor retreat have collided with a wave of outmigration. Cities that once felt untouchable are now ground zero for the market's sharpest declines. For many, the dream of homeownership has turned into an expensive waiting game, one where the next move is far from certain. Austin's skyline is still dotted with cranes, but the mood has shifted from optimism to anxiety. Since 2022, home prices are down 13%. The real problem isn't just falling values, it's the sheer number of empty units piling up. Builders finished more than 41,000 new apartments and nearly 9,000 single-family homes in the last year alone. Vacancy rates for multifamily properties have climbed above 11%, the highest since the last housing crash. Nearly half of all listings are now showing price cuts, and the average home sits unsold for over 50 days. Rents, once a source of steady returns for landlords, have started to slide. Landlords who locked in construction loans during the boom are struggling to fill units, offering months of free rent just to compete. Some are now underwater on their loans, unable to cover payments as revenue drops. City planners warned as early as 2023 that new supply was outpacing demand, but permitting kept going. Now, with net migration slowing and fewer people moving in, the oversupply is impossible to ignore. For buyers, it means more choices, but also a risk that values will keep falling as inventory grows. Houston faces a different kind of stress. Prices have slipped 4% year over year, but the real trouble is brewing in the suburbs and newer developments. Adjustable rate mortgages, popular when rates were low, are starting to reset. Monthly payments for many owners are jumping by hundreds of dollars overnight. In 2025, foreclosure starts in the Houston metro are up more than 50% from last year. The hardest hit neighborhoods are those built quickly during the pandemic, where buyers stretched to get in. Notices of default are arriving in clusters, especially in Northwest Harris County and outer ring suburbs. Developers faced with unsold inventory are slashing prices and offering incentives to offload spec homes. Some investors, hoping to cover losses, have turned to short-term rentals, but the market is saturated. For families who bought with minimal down payments or took on adjustable-rate mortgages, the payment shock is now pushing many to the brink. Both Austin and Houston show how quickly the Sunbelt boom can flip. In Austin, it's too many homes and not enough people to fill them. In Houston, it's a wave of mortgage resets and a spike in forced sales. Across both cities, the result is the same: owners trapped by falling values, landlords squeezed by empty units, and buyers wary of catching a falling knife. The days of easy gains are over. Now the question is, who can weather the next round of shocks, and who will be left holding the bag? The cost to buy a home in 2025 isn't just about the sticker price. It's about the math that locks people out. The national average for a 30-year fixed mortgage is now hovering near 6.9%. That's double what buyers faced just a few years ago. For a median-priced home, the monthly payment has jumped by more than $800 since 2021. At the same time, wages have barely budged. According to the latest data, average earnings are up just 4% year over year, while consumer prices have climbed nearly 6%. That gap means paychecks aren't keeping up with the cost of living, let alone the cost of owning. Inflation has pushed up everything from groceries to gas, but it's the mortgage bill that hits hardest. For many, the dream of trading rent for a mortgage has faded. Even buyers with solid credit are being squeezed by higher rates, steeper taxes, and insurance premiums that eat into every dollar. This funding stress is showing up in stalled sales and shrinking loan approvals. The result? Fewer people can afford to buy, and many who already own are stretched thin, waiting for relief that hasn't come. Since 2023, home builders have been finishing about 1.4 million new units each year, single-family houses, condos, and apartments. But the number of new households forming has dropped below 900,000 annually. That leaves more than 500,000 homes added each year with no one to fill them. In Sunbelt cities like Austin, Cape Coral, and Houston, the gap is even wider. Builders race to meet pandemic demand, but by 2025, active listings in these metros have jumped as much as 60%. Vacancy rates for new apartment buildings in Austin and Jacksonville now top 10%. Many landlords offer months of free rent just to compete. At the same time, remote and hybrid work have changed where people want to live. More than 40% of full-time workers now spend at least part of their week at home. High earners are leaving expensive metros for cheaper regions, draining demand from cities that once felt untouchable. The result is a new kind of oversupply, one driven not just by overbuilding, but by a migration wave that's still reshaping the market. For buyers and owners in these cities, it means more empty homes, more choices, and a real risk that prices keep sliding as the dust settles. Spotting trouble in your local market starts with tracking the right signals, not just headlines. The most reliable way is to set up alerts for neighborhood-level listings using your local MLS or a site like Redfin. Watch how many homes are for sale in your zip code and how fast they are moving. If listings keep piling up and the average days on market climbs week after week, that's a warning. Dig deeper by checking what share of active listings have had at least one price cut. When that number jumps above 30%, it means sellers are struggling to find buyers and are getting nervous. You can also filter for homes that have been relisted after a failed sale. Rising relistings point to deals falling through. These simple tools give you a front-row seat to shifting demand, long before the official stats catch up. Affording a home in 2025 means setting hard lines before you start shopping. The gold standard: keep your total monthly housing costs, mortgage, taxes, insurance, and HOA fees at or below 30% of your gross income. If a lender approves you for more, that's a red flag, not a green light. Run the numbers on every property, factoring in the true cost of ownership, not just the principal and interest. Compare the monthly outlay to local rents. In many crash-prone cities, renting the same home costs hundreds less per month, with no risk of losing equity if prices fall. Avoid stretching for a minimum down payment if it leaves you cash poor. And never take on an adjustable rate mortgage unless you can handle a payment jump. The safest move is to buy only what you can afford on a fixed rate, with a cushion for rising taxes and insurance. In risky markets, patience often pays more than rushing in. Between 2020 and 2022, U.S. home prices soared over 40%, but by 2025, cities like Oakland and Cape Coral have seen declines of up to 29% and 20%. The evidence is clear: rising mortgage rates near 6.9%, surging insurance costs in Florida, and oversupply in places like Austin and Denver have pushed many buyers underwater. Data from Zillow and the National Association of Realtors confirm a national shift. Inventory is up 20% year over year, while days on market have climbed 30%. Yet the full impact of hybrid work, regional migration, and future policy remains uncertain. Local price differences within metros can change outcomes for buyers, and not all risks are visible in headline numbers. What's clear is that affordability has been stretched beyond historic norms, and real estate in these 10 cities is no longer a safe bet. The warning signs are documented. In 2025, caution is not optional, it's essential.